Hello, dividend growth stock investors. It is Colby, the DGI Crab, wishing you a happy Star Wars Day. May the 4th be with you here on a Sunday where we are searching for value in any galaxy. Hopefully, not one too far away, but right here in our own backyard where they're nice and easy to access. Now, I'm not a professional financial advisor, and the content of the channel should be considered primarily for entertainment purposes. All right, newbies, if you're new to the channel, I'd like you to know that every Sunday I go over all 60 of the stocks that my channel focuses on. Now, I've split those into 4 separate categories or tiers based on the age and time horizon of the investor. Now, what my personal allocation strategy is using this method to acquire passive income is I'm going to start out by putting 50% of my money into some age-appropriate ETFs for diversification, and I'm going to target these stocks when they're yielding 30% or more above the 4-year average. The exception being my top 10 favorite stocks. I will go into those when they're at 20% or more above the 4-year average yield. I remain within my personal age tier unless there is a stock in a different age tier that is yielding at least 50% or more above the 4-year average. And if in any given week there's not a buyable stock within my age tier or another one that's yielding 50% or more in another age tier, I won't invest less. I'll just continue to add more money to the ETFs for that particular week. So let's jump right into the tiers, you guys. You know the name of the game here. So, going into it, here is tier 1. Now, this is for our 18 to 30-year-old investor, where we're looking for, cumulatively among this group of stocks, a starting yield in the mid 1%. But the main thing we want here is an annual dividend growth rate comfortably above 10%, so we could really get that dividend snowball going while you're young and you've got plenty of gears in the market to let that snowball happen. Sorting these stocks by the valuation tab, where I am comparing the 4-year average yield, which I update every single week, to the current day yield. If we have stocks in the green category, they have hit that 30% or more discount, and they are in my personal buy zone. So we have the same 3 here as last week: Nike, Nordson, and United Health, all looking very underpriced still to this day. And United Health, under $400 a share, I think is a great purchase all the way from age 18 up to age 53 or so. You're getting a starting yield on UNH above 2%, which when you compare that to the 4-year average yield of 1.34%, not too shabby. If you guys are getting tired of buying Nike or Nordson, UNH looks very, very appealing right now, if you ask me. I did not add any UNH this past week. I had already allocated my funds elsewhere, but if UNH stays below $400 come Monday, I'm definitely going to be adding a little bit to my UNH position. And by the way, you'll remember Microsoft, one of my top 10 favorite dividend stocks. I had pointed out just a couple of short weeks ago that when it was yielding above its 4-year average, not even 20% above, just above, I said that I think that that's a great time, especially if you're 30 or younger, to add to your Microsoft position at that point in time, because Microsoft just doesn't trade even at that low very often at all. And wouldn't you know, Microsoft rebounded hard this week, and they have jumped. They were sub $400 a share. They were actually down below $375 at one point in the last 30 days. Now they've jumped all the way back up to $435. Got to jump on that quality while it's there, and with Microsoft, it usually isn't there for long. Don't say the crab didn't tell you that, guys. All right, now for tier 2, our age 31 to 41-year-old investors, starting yield, we're looking more in the mid-2s to maybe mid-3s most of the time, and a year-over-year annual dividend growth rate of 7-8% on the group. We are still looking at our 4 from last week in this category also: Target, Hershey, NextEra Energy, and Starbucks. All look like very appealing ads for this particular age range, with Hershey and Target being above the 50% or more starting yield, I think that you could add this in just about any age tier and feel pretty good about it. I don't think that any of these stocks are going to stay down for the long haul. I'm very happy to add to Target under $100 a share, getting 4.6% starting yield when the 4-year average is just 2.56. Sign me up for that all day, every day. Some of you may not like Target. Maybe you're not really liking the retail space in general right now with consumer spending continuing to be pretty tight. But Target is a dividend king, more than 50 consecutive years of increasing that dividend. Got to keep that in mind, you guys. Target has been through downward cycles in the economy before many times, and they continued to increase their dividend, whether it was COVID, the financial crisis of 2008, 2009, the dot-com bubble bursting. Heck, Target goes back even before the stock market crash in 1989. They were increasing the dividend year over year in the late 80s. So I'm very happy to continue to add to that one. You just got to have that long-term perspective, you guys, and not be concerned about the short-term problems that present themselves to a company. In tier 3 we go now, which is the 42 to 53-year-old investors. We're wanting to keep getting our starting yield a little higher the older that we go, 3.5 to 4.5% starting yield. Most of the time is the range we're looking to acquire stuff at. Still want to get a good solid annual dividend growth of 5 to 6% across the board. We have Archer Daniels Midland, still down below $50, remains the top option in this category for yet another week. Pepsi, a top 10 favorite stock of mine, not only has hit 20% or more above the 4-year average yield, but has more than doubled that, 43.7% above the 4-year average yield. You can get Pepsi at a starting yield right now of above 4%, 4-year average of 2.82%. Great time to be adding Pepsi. This is the one that I actually hit the hardest this past week. I want to have strong positions in my top 10 favorite stocks, and Pepsi is giving me a wonderful buying opportunity at these prices. Hormel Foods and Genuine Parts Company also still looking appealing. Hormel under $30, absolutely. Genuine Parts Company has been down into the mid 110s. It's climbed a little bit back up to 120, but still looking appealing at these particular prices. T. Rowe Price has been in the buy zone, but like I was telling you guys, I update this 4-year average yield every single week, which means that a stock like T. Rowe Price, it's been down for a while. The longer it's down, every week, this 4-year average yield just creeps up by a basis point, maybe 2. And it's right on the outside looking in, not in my buy zone right now. Probably needs to get down below $90 a share before I would consider adding more to that. Keep a very close eye on Chevron Corporation. This is a very high quality stock. Probably, it's not in my top 10, but it's probably in that 11 to 20 range, probably somewhere in there. If you were adding Chevron at these prices right now, I certainly wouldn't fault you for it if you can get it at 5% or better. It's not the worst deal in the world. Johnson & Johnson is in my top 10 favorite, not quite in the buy zone, very, very close. I think I'm going to need J&J below 155 as my threshold. I'm a stickler on this stuff, you guys, even for ones like J&J that I absolutely love. I want to keep my starting cost as low as I can for these individual companies. Tier 4, the 54 and older crowd who need to acquire higher starting yield to get to financial freedom. Not as many years left in the market to enjoy the dividend snowball of dividend increases. So your starting yield, you're probably going to want to average at minimum 5% starting yield. And I don't want to throw dividend growth entirely out the window here. You still want to get like 2 to 4% year over year dividend growth. None of these 10 stocks that made the cut for the high yield category are in the buy zone. Realty Income has been in that number 1 position for the last 9 months or so, pretty much. And, I wouldn't fault people for continuing to add to Realty Income when the current yield is above 5.5%. But I would probably be more inclined to add to the Tier 4 ETFs. I have alluded to my top 10 favorite stocks. These are those stocks. All of them are put somewhere in tiers 1 through 3. Right now, the only one in the buy zone is Pepsi, but Johnson & Johnson is very, very close. And Union Pacific has been falling a little bit recently. Still haven't gotten to my buy zone on them just yet, but they're more than halfway there. If this gets down in the 210 range, it's going to start to look really appealing. I haven't gotten to add to Union Pacific for a while. I'd be absolutely fine to add more to it again. Procter & Gamble, keep an eye on this one as well. I needed to drop some more, but Procter & Gamble, Johnson & Johnson both did dividend increases in April that were right in line with what we typically expect, right around the 5% range. So super blue chips, got to grab them while you can. Okay, now my strategy for the week is as follows. So starting with the ETFs, going over the allocations here for the younger crowd, I would be doing, if I were 30 or younger, I'd be doing 25% every single investment period into the S&P 500. I'd do 15% into a small cap, 5% into VIG to get some dividend growth going in an ETF, and then 5% in VYMI, which is the only non-US investment that I make. I do 5% in VYMI across all 4 age tiers. And these are just kind of general suggestions. There might be versions of these ETFs or versions of these that you like better, but just based on my own personal research, I've been through a ton of ETFs to put this together, and I just think these are the best of the best in their particular categories. So for tier 2, 25% into the dividend appreciation. I'm not going to totally stop with the S&P 500 and the small caps. I'm just going to allocate less to those, the closer to 40 that I get. And then tier 3, SCHD, VYM, DHS, 3 excellent dividend-focused ETFs. Yep, I think SCHD's been the best performing on the dividend front out of the 3, so I would probably hit that one the hardest. But I think having all 3 in your portfolio is not a terrible idea. But if you want to pick just one and go hard into that one, that's also not a bad idea either. And then for the older crowd, I like to do a stock backdrop of SPYD, the 80 highest yielding stocks in the S&P 500 at a 15% allocation, and then 5% allocations into high yield alternative investments that up until age 54, I personally just don't think it's worth messing around with. But when I need to start adding the high income immediately, I like SPHY for high yield bonds, PFFA for preferred shares, MLPX for that MLP exposure, and the trio of Devo, JEPQ, and SPY-I for covered call ETF exposure. Now, since there weren't any stocks in that tier 4 category that were in the buy zone for me, I would be doing a double down on the ETFs as opposed to reaching for something like Realty Income or Prudential. And just go 30, 10, 10, 10, just all the way down the board. Except for VYMI, I would keep the international at 5%. Now, for the stock breakdown, for the older folks, I'd do that extra 5% into Pepsi. It's so undervalued right now, and it's yielding above 4%. Still want to add a little bit of dividend growth to that portfolio if you can, so I like adding a little bit to Pepsi here. For everybody else, for the tier 1 folks, we're looking at 10% allocations into Nike, Nordson, and UNH to cover the tier 1 undervalued stocks. Then 5% into Pepsi, a top 10 favorite of mine, and then 5% each into Target, Hershey, and ADM, which are all yielding 50% or more above the 4-year average yield. For tier 2, I'm going to place the emphasis on my own tier for Target, Hershey, NextEra, Starbucks, then grab Pepsi, and then go up to tier 3 for ADM, and then down into tier 1 for Nike, Nordson, and UNH. For the tier 3s, Pepsi is going to be my primary focus. I'm going to hit my own tier after that, so ADM, Hormel, GPC. I'm going to dip down to tier 2 for Target and Hershey, and I do think Nike yielding 2.75 is a high enough starting yield for the tier 3 folks to enjoy that value as well. You could replace Nike here with maybe UNH, which is also yielding above 2%. It just depends on what your preference is over those two. But I've been preaching Nike for months now. It hasn't treated me well from a share price perspective, but the dividend's still coming through and looks safe, so I'm going to keep at it. All right, guys, what are you buying this week? Let me know down in the comments below. Share the channel with your friends, like and subscribe, all that good stuff. May the 4th be with you.